Welcome to the Deep Dive from Talk Tickers. We cut through the earnings call noise to bring you, well, the crucial nuggets.
That's right, so you're informed without the overwhelm.
Today, we're diving into US Foods Q2 FY 2025 earnings. The call just wrapped up August 7th.
Yeah, and this isn't just about the numbers, it's really understanding the strategy, the shifts, what's shaping their future in a pretty dynamic market.
We'll unpack what management emphasized and, where the market's attention seems to be.
Exactly. We've distilled the key insights.
We dug through the transcript, the presentation, the notes, so you get the essentials without hours of sifting. Let's get straight to it.
Okay.
So kicking things off, US Foods Q2 results. It's kind of a fascinating picture, actually. A big beat on profit, but a miss on revenue. A classic Wall Street head-scratcher, right?
Absolutely. Let's break it down.
Okay, headlines first. Adjusted EPS came in at $1.19.
Yeah, and that comfortably beat the consensus. Estimates were around $1.14, maybe $1.15.
So like a 4-5% beat on the bottom line. Pretty solid.
Very solid. But here's the other side of the coin. Revenue. That was roughly $10.08 to $10.1 billion.
And the street was looking for more like $10.18 to $10.19 billion.
Exactly. So a miss of about maybe 1.1%.
And the market's reaction?
Cautious. Definitely cautious. Despite that EPS beat, the revenue miss clearly weighed things down. Stock dropped pre-market.
So investors are really watching that top line.
It seems so. Prioritizing revenue growth even when profitability looks good.
Okay, so let's dig into that. How did they beat on earnings despite missing on revenue? Let's unpack those financials.
Right, because the profitability metrics were, frankly, impressive.
Adjusted EBITDA hit a record $548 million. It's up 12.1% year over year.
A record number. And the adjusted EBITDA margin expanded too, up 40 basis points.
So 0.4%, landing at a record 5.4% margin.
Yeah, so what this tells you is even though sales only grew, 3.8%, management is clearly executing this transactional playbook. They're focused on value, on profitability, not just chasing revenue.
Margin expansion and cash generation seem key.
Absolutely. Look at gross profit, up 4.2% to $1.8 billion. Margin there, 17.6 to 17.8%.
And cash flow.
Operating cash flow year to date, up $104 million. Now at $725 million. That's strong.
And they improved their leverage too, right?
Net leverage down to 2.6 times net debt to adjusted EBITDA. It was 2.8x.
So strengthening the balance sheet.
Exactly. Better financial health. It gives them flexibility.
Okay, so strong profits, better balance sheet. Where are the gains coming from? Let's look at the customer segments.
Right, because it's a bit of a mixed picture there, but definitely areas of strength.
Independent restaurants, that's their key growth engine, right?
Yep, and they saw 2.7% independent volume growth.
And that's the 17th consecutive quarter of market share gains there.
17 straight quarters. And it seems to be accelerating. Net accounts grew about 4% year over year.
Which they said was the strongest since Q4 2023.
Right, and independent organic case growth picked up to about 3% in June and July.
So that core segment is performing well. What else?
Healthcare, another really strong performer, about 5% case growth.
And that's 19 quarters of share gains?
19 consecutive quarters, yeah. And hospitality also added positively, about 2.4% case growth.
So how are they doing this in what they call a soft but stable market?
Well, it points to strong execution, right? Targeted gains, and these self-help initiatives really seem to be working.
But it wasn't all positive growth. The chain business.
Right. That saw a 4% volume decline.
Mostly due to a strategic exit, they said. Had a 300 basis point negative impact.
Yeah, and also the divestiture of Freshway back in Q1, that small produce processor.
That hit total case growth by almost 50 basis points.
Higher volume, but lower margin. So getting rid of it fits that profitability focus.
Okay. And they expect chain volume to improve later in the year.
Yeah, they mentioned new business wins should help in the back half. Something to watch.
So this brings us to their strategic initiatives. These seem crucial to the results.
Definitely underpinning the performance. Operationally, they're pushing hard on this Descartes routing initiative.
Like smart routing for their trucks.
Basically, yeah. Advanced routing optimization. It cuts miles, saves fuel. It's live or rolling out in 65 markets now.
Covering about 90% of their miles.
Right. And it led to their best ever cases per mile performance. Over 2% better year over year, almost 6% over 2 years.
Impressive efficiency gains. And the UMass system.
That's about standardizing operations, getting everyone on the same page, rolling out to over 60 of their 74 markets by year-end. More consistency.
And they're building new facilities, too, investing in infrastructure.
They are. New semi-automated warehouses. One just started limited shipping in Aurora, Illinois.
That's the 310,000 square foot one.
Mm-hmm. And they broke ground on another expansion in Austin, Texas. Also semi-automated.
The idea is more efficiency, better productivity, better quality, fewer accidents.
That's the plan. Enhance everything, really. Reduce injuries. Of course, it's significant CapEx.
Yeah, is there a risk of overinvesting there? Or is it future-proofing?
Well, management argues it's essential for long-term scale and efficiency. State-of-the-art tech to handle growth and stay competitive.
Makes sense. What about other growth levers? Pronto.
Ah, yes. Pronto. The small truck delivery service that's now live in 44 markets.
Expanding penetration to 20 more by year-end.
And it's driving double-digit case growth uplift for the customers using it. Think small restaurants needing quick, smaller drops.
It's a targeted service.
Very. And they raised the sales target for it, too, from $1 billion originally
to $1.5 billion by 2027. Ambitious.
Shows confidence in the program.
Oh,
and they're using Gen AI, too.
Oh, how?
Automated order guides for the sales teams, internal stuff like replenishment, labor planning, spreading it across the company.
Okay, shifting back to profitability. Those initiatives seem key to the EPS beat.
Absolutely central. The Strategic Vendor Management Initiative that's saving costs on goods they buy.
Over $50 million saved year-to-date already.
Right, and the full-year target is over $110 million. And get this, they think they can beat their long-term 2027 target of $260 million.
Wow, so they're finding more savings than expected.
Seems that way. Real cost discipline.
And in private label, their own brands.
Another big margin driver. Penetration grew over 80 basis points year over year. It's over 53% now with core independent restaurants.
Higher margins on those products to figure out.
Exactly. And they've got new launches planned, like a scoop launch in the fall.
They're also tackling inventory losses.
Mm-hmm. New processes, scanning tech, targeting over $30 million in savings in 2025, maybe more in 2026.
Plus indirect spend management, another $45 million saved this year.
Yeah, it's, like you said, finding savings under every rock.
And we should touch on culture and sustainability, too.
Yeah.
Injury rates down.
Significantly. Down 21% year over year, 35% over 2 years. Great for employees.
Emissions.
Scope 1 and 2 greenhouse gases down 16% since 2019, nearly halfway to their 2032 goal.
And they have that initiative to hire more military veterans.
Right, Mission 2030, aiming to hire another 3,000 vets by 2030. Focus on people, community.
Okay, let's look ahead. The guidance. What are they telling us about the rest of FY 2025?
This is always revealing. So net sales growth guidance stays the same, 4-6%.
Okay, no change there.
But they raised the lower end of the adjusted EBITDA growth guidance, now 9.5-12%, up from 8-12%.
So more confidence in profitability growth.
Exactly. And they also raised the adjusted diluted EPS growth guidance, now 19.5-23%, up from 17-23%.
Powered by that earnings growth and share buybacks.
Mm-hmm. And slightly lower expected interest expense helps too, about $300 to $315 million now.
Management sounds pretty confident then.
Very confident. They expect volume acceleration in both independent and chain segments in the second half.
And this fits their long-range plan through 2027.
Perfectly. That plan targets what? 5% sales CAGR?
10% adjusted EBITDA CAGR.
At least 20 basis points margin expansion yearly.
And a 20% adjusted EPS AGR.
Right. So the question is, does the market fully appreciate that long-term picture, especially after reacting to the short-term revenue miss?
Feels like that classic short-term noise versus long-term strategy tension.
Could be.
So what does this all mean for you, the listener, maybe an investor? The industry backdrop is still, as they say, soft but stable.
Mm-hmm. Macro pressures. Tariffs impacting consumers. Restaurant traffic still down year over year, though it improved a bit in Q2.
It's still down 1.1% though. But the long-term trend of eating out holds up. How does US Foods navigate this?
Well, they position themselves as the leader, right? The only pure play US-focused national distributor.
And their strategy?
Focus on those profitable segments, independence, healthcare, plus all those self-help initiatives we talked about. Cost savings, productivity, private label.
That's how they plan to outperform the market, even with headwinds.
Exactly. Driving profit and margin even when the top line is challenging. It's pretty impressive execution, really.
And then there was the elephant in the room, the PFG speculation.
Ah, yes. Performance Food Group. The CEO addressed it directly.
Confirmed US Foods approached PFG proactively.
Yes. believing a combination could create significant value, economies of scale, growth, efficiencies, the whole package.
Bold move. And PFG's response?
Declined to engage so far, that's the word.
But U.S. Foods management was clear.
Crystal clear, they said. They are highly confident in hitting their own long-range plan, with or without PFG.
So, sticking to their strategy, but open to big opportunities.
Seems to be the message. And their capital allocation shows it. $250 million in share buybacks in Q2.
Part of that big $1 billion authorization from May.
Right. Returning capital, but still investing in the business too. Balancing both.
All right, it's time for our This Is Not Financial Advice segment, where we pitch an outrageous but plausible trade idea, hedge fund style.
Always remembering this is just for fun, conceptual exploration, not actual investment advice.
Definitely not. Okay, we've unpacked the numbers, the strategy, the market reaction.
Yeah.
It's complex. So the trade idea.
How about this? Go long USFD.
Go long after the stock dropped on the revenue miss.
Exactly. Look, the stock took that 7+% hit pre-market.
Yeah.
The market is absolutely fixated on the top line number right now. Valid concern if you need explosive growth today. But look deeper. Management seems to be building this lean, margin-driven compounding machine. Record-adjusted EBITDA. Record margin. Strong cash flow.
Aggressively buying back stock.
Under that $1 billion plan. And they raised profit guidance for the year. Raised it with a clear line of sight to beating long-term cost targets.
And those core segments, independent restaurants, healthcare.
Still gaining share consistently. 17th, 19th quarter straight. Programs like Pronto adding fuel with higher targets now.
So the argument is the market's current reaction, focusing on that revenue miss,
Might be overlooking the really strong operational execution and that clear path management laid out for double-digit earnings compounding through 2027.
could be a classic case of short-term noise obscuring long-term value. Maybe a solid entry point if you believe the operational story.
That's the thesis. Betting on execution and margin expansion winning out over a slightly soft, albeit stable, top-line environment right now.
Okay, interesting place. So wrapping this all up, U.S. Foods Q2, EPS beat, revenue miss, market reaction.
Roar.
Caution.
Yep. But underneath that headline mix, there's a strong focus on margin expansion, operational efficiency wins, and strategic initiatives like Pronto and automation.
Suggests a company executing a very clear long-term strategy for profitable growth.
Regardless of industry headwinds, it seems, they're prioritizing margin and cash deliberately.
We've really taken a deep dive into the numbers and the narrative from U.S. Foods Q2 call today.
Hope this analysis gives you some valuable insights. What really stood out to you in their report?
Yeah, are they right to focus so hard on margin over the top line right now?
And, thinking bigger picture, how might their strategy, especially that focus on independence and efficiency, shape the whole food service landscape going forward? Lots to think about.
Thanks for tuning into the deep dive.
Yeah.
Remember, this is purely informational, not financial advice.
We'll catch you on the next deep dive.